Hello, welcome to Geojit Spotlight. The market has been in a correction mode. Nifty has corrected by 5.6% from the peak. Mid and small caps and some recent listings also have corrected significantly. We have conveyed two messages consistently through Geojit Spotlight for some time. One, valuations are elevated in India, particularly in mid and small caps. Two, at high valuations, the market is vulnerable to correction, and the corrections come mostly from unexpected triggers. Let's look at the factors that contributed to the correction. First, we must understand that this correction is India specific. Most other markets, developed and emerging, are stable. So why did India correct by more than 5%? The most important factor that caused this correction is the sustained big selling by foreign portfolio investors, which in turn is due to the sudden change in the FPI strategy to sell India by China. Due to the underperformance of Chinese stocks, both in China and Hong Kong, foreign portfolio investors had incurred heavy losses. So they had sold heavily in China. This pushed valuations of Chinese stocks to very low levels. The price earning multiple for Shanghai Composite and Hang Seng, the Hong Kong index, where Chinese stocks are listed, had declined to less than 10. Contrast this with the high valuations in India, where Nifty is trading at around 21 times and mid and small cap indices are trading around 30 times, PE multiple of 30 times. Recently, the Chinese authorities started implementing monetary and fiscal stimulus to stimulate the Chinese economy. Many FPIs believe that these stimulus measures will trigger revival of growth in China and improve their corporate earnings. This hope is behind the Sell India, Buy China strategy. It is a rational response to the high valuation in India and the cheap valuations of Chinese stocks. But this Sell India, Buy China strategy is likely to be a short-term tactical trade. The growth prospects of India is much better than the prospects of China, which is facing some deep structural issues. Also, if you take the stock market performance of the last 5, 10, 15, 20 years, India's performance is far superior to China's. So this is likely to be a short-term tactical trade which will not last long. Even while foreign portfolio investors have been selling heavily, domestic institutional investors have been buying aggressively. During the last 6 trading days in India, FPI sold stocks for rupees 50,011 crores in the cash market. DIIs more than matched this selling with aggressive buying of stocks worth rupees 53,203 crores. This aggressive buying by DIIs and the huge resources at their command will support the market and facilitate a bounce back very soon. The Middle East conflict has not impacted the market so far. Crude has risen, but not alarmingly. But if the conflict escalates and Brent crude spikes about $90 a barrel, markets will be seriously impacted. This remains to be seen. Investors can adopt a cautious investment strategy at this time of uncertainty. The weakness in the market can be used to gradually accumulate fairly valued large caps, particularly financials. And within financials, the leading private sector banks, which are attractively valued. Patience is required to see this strategy bear fruits. Similarly, IT, capital goods, telecom, and autos, these sectors also present good buying opportunities in the leading stocks in these segments.